Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. It's December 16th, about 5 o'clock. And as usual, we're looking here at the S&P 500 index. And I've got the last 5 waves kind of drawn here in yellow with the channel there in blue. And of course you can see that we broke the channel there in blue, retested it in what appears to be a wave 2, and we're in the early stages of wave 3, probably. Now there's no way to know for sure, but again, like I've talked about before, you need to have some sort of way of identifying when you want to be out of the trend or in the trend. I had somebody tell me the other day there's a timing service that's it's pretty good. It's it's got him Jim Rohrback, and he's got a trend following system. And basically what happens, excuse me, I'm still getting over my muck that I had 2 weeks ago. But anyway, Jim's system basically keeps you in the trend. If you should be, if it's trending upward, and when the trend changes and it starts going down, it makes sure that it gets you out of the trend. And of course, it's if you're like any trend following system, and maybe people listening to this don't know this, but if this is the new next trend where I've got it marked here with the little lines in yellow, I probably don't get into the trend until right about here, right? And then, of course, what happens? It pulls back immediately. So immediately once I get into the trend, I'm losing money, right? This is the way trend following systems work. And then, several weeks later, I'm back to even and then making money, okay? But I'm in all this way, okay? And then I get something like this, and maybe I get out right here. It takes me out like right in here. Okay. And then of course, it pulls back even further, which I'm glad I'm out. And then it starts ripping back up to the upside. And the trend following system gets me back in maybe right here. And so, I'm making money. But then now I'm losing money. And the trend following system gets me out. So in other words, in a topping market, a trend following system is going to chop you up. Here, that's just the way, that's the nature of a trend following system. But if you're in a big bull market, you capture, you don't, it's like a loaf of bread, you don't get the heels, you get the middle, okay? And I had this person tell me, well, I like to just get in and let it go up, and then when I feel like I've got a pretty good gain, then I get out. And of course I chuckled just like I did then, because, how do you know if that gain is good enough? I mean, let's say you got out with a 4.5% gain and the market decided to go up another 15% from there. I mean, aren't you kind of kicking yourself? And then don't you feel a lot of pressure to get in? So, the point is, no system is perfect all the time. But if you have a system and you follow it, it should keep you out of the big bear markets and keep you in a big bull market, okay? The reason I talk about Elliott Wave so much is because it not only has a good way of identifying these pullbacks and when they might happen, but more importantly, it's a good methodology for identifying when you're going to have a big bear market, likely. So let's just review that. Why are we saying that there's going to be a big bear market? Well, so in Elliott Wave, once you've had 5 waves, you usually get a significant retracement of the trend. Okay, that's the rule. So I want you to see here. Let me try and do it like this. So if I can get this whole thing on the screen, I'm not going to be able to get this whole thing on the screen probably, but get most of it. So what I want you to see here is this is a wave 1. Now this 2 here is a special kind of 2. It's called a flat. So it goes A, B, C, where the bottom of A and the bottom of B are about the same. So that's called a flat. So that's 2. And then all this is 3, all the way up to here. And then we have 4. And then we have 5 up to there. Okay, and of course you can kind of see in here, we've already marked it before, but there's a 1, 2, 3, 4, 5. Okay, now what I want to do is I want to back up even farther. Okay, so this whole pattern right here is a 4. So let's go back and look at all data. So here's the 4 in this run up right here. So let me put log on so you can see it. So here's a 1, 2, 3, all the way to here, 3, 4, and then this last thing that I was talking, this thing I started talking about first, that 5 is a 5. So what we've got here, if you're not picking up on this, is that we're at the end of a 5 of a 5 of a 5 of a 5. That's 4 degrees of trend, and that just means that so it goes all the way back to this, starting in 1929. That just means that a significant portion of this trend that started in 1929 is going to get retraced. Now, what I'm saying, based on my study of this model and just the economics we have in general, we have a lot of debt, a lot of deficits. There's major economic problems in the U.S., and this is going to show up in the stock market for sure. Even though all the economic news, you got to remember, a lot of the official economic news comes from the government. So they manipulate the data to make the government look good. I mean, that's what the government does. So what I'm expecting to happen here is at least a retracement to the wave 4 low, which is right here, which is very, very common in Elliott wave. Very, very common. Okay. In fact, there are many times there are many trends I could show you where the market retraces back to the 4th wave low. So where is the 4th wave low? Well, the 4th wave low here is about 591 or 600. Let's call it 600, between 500 and 600. Well, that's 2,000 points from where we are right now. 2,000. You know, buy and hold is a methodology that, under this particular scenario, it can and will be very damaging to a portfolio. And you know, that's the nature of, you know, this what's called a fractal based system. Why does this happen this way? I have no idea. But at every degree of trend, the market makes 5 waves up and 3 waves back at every single degree of trend. And I don't know why it happens, but it happens. So that's why I use it. Now, from day to day, it's very difficult to use it to trade because, you know, you can be, well, I'll just show you. And you could be in a, let's have a 1-year chart here. And let's say I'm right in here. Okay. I mean, how do I know? I don't really know if this is a 1 or a 2 or if I'm in the middle of a 3. I mean, you see what I'm saying? There, it's very, very difficult to see this unless you step back and look at a much larger picture, which is why we do that. So even right here, you don't know this is a wave 1. But what you do know, and we've talked about this particular methodology here. Let me go back to a weekly chart. Anytime you've had a significant pullback like you had in 2009, and when you're trying to look to get into the market, what you want to do is you want to identify an important low. So here's a low. Okay, we ran up, and let's say you got in here. Okay, you got in right here because this was the low from this pullback, and then the market pulled up to here. So you got in, and it went up, and then it pulled back, and then somewhere wrong in here you got out. So you lost money, okay? But then it came down and made a lower low right here. And then right in here, you get in, because what you do is you're looking for, a close or a break of the high of the low day or the low week, which is this. So somewhere, in this area, hold on. Somewhere in this area right here, we got in, or you could have waited till the end of the week and got in up here. Okay. But normally what happens is the market closed right here. Okay. It gapped down a little bit and then ran up. And once a market runs this far, it usually doesn't pull back. So especially at a bottom. So you could have got in here really easily and felt comfortable about it. Okay, so you got in here and we roll forward, and you can see, if you do the analysis on this, obviously you can see that was the bottom, or that was the beginning of the bull market. Now obviously we're in some sort of one, but we don't know really what the pattern's going to look like. So you have to wait till it unfolds. But this getting in at the high, at a break of the high of the low day, or the low week in this case. Here's the low week, here's the next week, and we broke the high of the previous week. That's a get in signal. Get in, okay? Now you can use the same signal here at the top too. Now, if it's easy to go back and pick the top. There's other places here where you would have used it. Let's say you got out right in here and it pulled back and the market went back up, and you had to have discipline to get back in right here. So if you use this methodology, you just have to be disciplined enough to actually act on it when it happens. Okay, that's the key. And we could go through all this, and you'll see that this is a pretty good methodology, but it can chop you up a little bit in bottoms and in tops. So here, which one of these? Let's call it this one. This candle right here was the high week. Okay, this next week we didn't close below the low. Here's the low. And you can argue whether or not we closed even below the low of this week. But you have to make that decision. You have to say, is that a close below the low? Or do you wait till the next week? Of course, the next week it gapped down and ran down. So somewhere along in here you would have gotten out. Okay? Of course, you didn't get the top, right? You missed out on all this profit somewhere between here and here. Okay, you missed out on this. This is a negative gain, negative dollars. Okay, but that is the way it is. That is investing. That is trading. That's just the way it is. There is no way to get all of this every time. And you might get lucky and pull out just because you got a feeling, I just don't like what's going on, whatever. But that feeling will not lead you to consistent results. You must have some sort of methodology that does something better for you than a feeling. All right, let's just do some analysis here on the last several months. we got a move down from the top right here. So there's a move down, and then there's a rally back up, but a lower low. Okay. And then a fall. So right here, right somewhere in here, we've got a trend change. Okay, no doubt about it. We went down, we rallied up to a lower low, or a lower high rather, and then we started making lower lows. That is a trend change. Now, on that particular scale, that's a trend change. Just like here, well, this isn't a trend change because it went on to make higher highs. But in other words, I can zoom in on like a 60-minute chart, and you can find trend changes all in here. But on this weekly scale, this is a trend change. So if you're very aggressive, you could have got out right here. But if we look at this, we analyze this further. I mean, it went all the way down here, and then rallied up to what? A lower high, another lower high. Okay, and then rallied down. Well, first it went back up to a similar high. Okay, that's another flat. Okay, which is a more complicated pattern in the LA wave. But now it's made a lower low on a large degree. Okay, so we've got a low, a lower high, a lower low. Now on a higher scale, we have a low, we have a lower high, and now a lower low. This is a trend change. There's no doubt about it. The question now is, how long is it going to last? Well, if it in fact is a wave 2, okay, again, this is another good thing about Elliott. You can plan. If I'm aggressive enough, I can make trades that'll make me money as the market moves down into this support area where this 3 is. Okay, but that's where we're going. That's there's places along here where you might get a little bounce. You might get some bounces, at this low and at this low, but before we get any kind of significant bounce back up, we're going to this area, okay, between 17 and 1800. That's my best guess. And of course, if you're in a 401k, you do not want to experience that kind of loss. So it's your money. You have to decide. But I just showed you where the trend has changed. We broke the channel. As soon as we break this channel, it's definitely on down to here. Okay. But we've already broken this channel. It's just a question of breaking this channel and following on through down. So, and this channel goes all the way back to 2009. So we break this channel, we're definitely going to here. And if we break below this box, we're going all the way back to here. Actually, this is 2009 low. This is the 2016 low. So we're definitely going to the 2016 low. And if we break this larger degree channel, which I don't have on the screen, see if I can. Why is that not coming up? I guess I don't have it. If we break this red channel, then we're going to go all the way back to likely back to the 2009 lows, which is, like I said, between 600 and 700. So, like I said, it's your money, it's your decision. I'm just trying to help people get out of the psychology of it, because what happens a lot of times is people talk themselves into, well, I'm staying because it's probably going to bounce. Well, then it bounces, but they don't get out because they think it's going to newer highs because you get a 400 point up day or 600 point up day even, and then it doesn't go to new highs. It rolls over and goes lower, violently lower. And then they're kicking themselves, I should have got out, even though that was their plan. Their plan was to get out on a bounce. And then the market bounces and they don't get out. So this psychology is very, very powerful, and it will make you lose money. So I think that's clear to everybody. Probably most people have experienced that. All right. I'm going to skip the 13-week Treasury, look at the 10-year. The reason I'm skipping the 13-week Treasury is I've got another chart here to show you on the 3-month Treasury. But, likely there's a little bit more pullback in the 10-year before we go appreciably higher. Based on the chart, the 10-year could roll back somewhere between 2.6 and 2.2 before going higher. So just keep that in mind. It'll probably coincide with the market selling off. So as the market sells off, you're going to see more and more money flow into bonds, which is going to lower these interest rates. Okay, lower them one last time. There's going to be a lot of hype about it too, I'm sure. All right, let's look at, that's all I'm going to say about the interest rates right now, and we'll talk about them again in a second. All right, let's look at Germany. We've been looking at Germany, and let me go to 5-year, and the UK and these countries, and I said once we broke out of this channel, it's probably, we're definitely topped. And of course, you can see the trend change here. Here's a low, a lower high, a lower low, a lower high, a lower low. This has been making a downward trend for some time now. Japan, I haven't looked at it, so I don't know if it's outside the channel or not. Now I'm having a hard time loading data. All right, there we go. It's still kind of there at the channel, but looking weak. The UK, outside the channel. So, this looks like, as you might expect, looks like it's going to be some sort of global event in equities and bonds. And that's, that's where I think like people like Peter, and Peter Schiff is a super smart guy. I mean, I got nothing but great things to say about him. But I think this bear market is going to be one of those where there's literally no place to hide. You can hide in cash, you can hide in gold or something like that, but you cannot hide in equities, because they're in Switzerland or New Zealand or Australia or, some other place like that. I just don't think there's going to be a place to hide. This is going to be, every bear market is different. And this one's not going to be like the last one where you can run to the bond market, excuse me, or run to cash. Or run to foreign stocks or whatever. This one's going to be different, just like the last one was different from the previous one. It's always different. They never unfold quite the same. So, with that said, let's switch over to TOS charts, and let's look at, what is this? That's silver. Let's look at gold. I got another gold chart I'm going to show you in a minute, so I'm not going to look at silver or gold. Let's look at the euro, though. The euro, it looks like it wants to go higher, but it keeps wanting to touch this line, which I drew in here some time ago. But I think we're close to taking off the other direction, and certainly I'm going to be looking for an entry there to the other direction. Crude light continues to fall dramatically. Got a little bit of bounce last week, but it was pretty short-lived and rolled over. And we may get more bounce actually this week. We might get, this might be some sort of ABC that's going to come all the way up here around 56 before it rolls over again. So, or it could come up even higher around 58, because this could be an ABC. Again, a triangle. Anytime you have a triangle, it's an ABC, 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 so on and so forth. In fact, if we go back and look at the euro, you can kind of see this on the euro. I'm going to have to zoom in a little further. Let me go to a 4 hour and I'll show you what I'm talking about. Okay, right here you can see this looks like a 4 and then a 5, and then you have kind of got an ABC, 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 ABC. So here, let me draw this in here so you can see. Well, let me just zoom in and do it this way. So you can, on the euro, you can kind of see that, you have this move up to here, and that's A, right? And then down here to here, here, that's B, and then to here, to here, to here, that's C, and then here, whoops, I went too far. That's, so A, B, C, D, E, what, no, A, B, C, D, and then E. Now, if this is E, so that you can kind of see the triangle through here, if this is E, then this could be the start of a fifth wave that's going to be made up of 1, 2, 3, 4, 5, and then a 2, maybe back up to here, and then 3, strong 3 to new lows. So I'm looking for the euro. Really, again, it looks like it wants to go higher, but I think it's more likely that we're in some sort of wave 1. We're going to get a wave 2 bounce into here, and then there's going to be a 3. And a 4 and a 5, it's going to be a sharp sell-off into new lows for the euro before it goes higher. So that's kind of what I'm looking at. I don't really see, might once it makes a low and then comes back up here in a 2, I might trade the euro lower from here, but I really don't see a good place to get into the euro right now. So either long or short. So I'm sitting on my hands. And that's what you got to do sometimes, actually, sit on your hands. Now, there might be a better opportunity in the British pound. I haven't been looking as closely at the British pound, but just sit on your hands on the euro. That's what I would do for right now. All right. Let me look at these Dinaric charts. Dinaric is a guy I follow. This is the short term. This is a 3-month treasury. And what I want you to notice is this is where this black line here is where the Fed raises rates, so you get this real sharp gap up That's why there's like step changes in this black line. But here's where the market is. So you can see the market is substantially higher by almost 200 basis points higher, or what is that? That's really, I guess, 20 basis points, because this is well, I don't know what the difference is. I can't tell what this number is, what 2.43 is. If that's more than 0.243, so I don't know what that number is. Maybe it's 2.43%, but I don't think so, because we're not getting that in our bank accounts. But anyway, the point is there's a difference between these, and that's what I wanted to point out. This difference right here is the difference between where the market is setting rates and where the Fed is. Okay, so anytime the market is this much higher than where the Fed is, the Fed will raise rates. Okay, no question about it, they're going to raise rates again. Now, they're getting a lot of criticism for that right now because, people feel like maybe the economy is getting soft, but it is what it is. All right, the reason I wanted to show you this chart is what Deneric is saying is this last 5-wave move was very overlapping, and because of that, we'll make a pretty quick trip down to this these fourth wave lows here. There's a fourth wave low here and a fourth wave low here, and of course these lows are 2004 lows. So he's saying that we're going to go. This is the global Dow, the G Dow. And you can see how little we've moved so far, given how far that's likely to go. So, again, very, very bad for your 401k. You do not want to experience that in your 401k. That's just going to be damaging. Let's just see what the numbers are. I don't know what the numbers are on the G Dow, but right now it's at 2813. He's talking about it going to what was that, right around 1200, maybe 1180, something like that. So it's pretty good fall in the G Dow. And then this is gold. I wanted to show you gold. It really helps. Excuse me. Sorry, it really helps to have someone like Deneric, who's really a good chartist, to really kind of put all this in perspective. And you can see that C is way up here around 1550. And we talked about 1550 being a target for wave B, and then after that, of course, we get a wave C down. But when you're looking at the chart, it's harder to see that. It really is. It looks like maybe ABC is already done, and here's B, which it is. ABC, B, and now we're looking for C to come up here around, all the way up there to the top. And what do I got? I got a 4-hour chart. That's the problem. Let me get back on a. There we go. Yeah, so something, I've had something like this up here for a while. There's a gap right in here, back in this area around 2013. So, this could be A, B, this could be 1, 2, and then 3. This could be huge, right? So, so if you want to own some physical gold, now keep in mind we're expecting gold to actually make new lows back here. I think maybe as low as $700, but at least $1,000. Let me find for some reason I can't go back any further. I don't know why that is, but anyway, there's a fourth wave low that's back here that's around $700, and that's likely where gold is probably going to go. So we should keep our eye out for that. There's 15-year daily. Yeah, I can't figure out how to. I used to be able to go back further on that. I guess I have to create a new chart, which I won't do right now. All right, I don't think there's anything else we want to cover. I think we've covered quite a bit of it. Again, the most important part is this, really is this this S&P 500, because the market, most of the stocks follow the S&P 500. So we've definitely got a trend change. We've definitely got lower highs and lower lows. And if you're in your 401k, that's not, you don't want to be in an environment where there's lower highs and lower lows. Now, we might get a bounce early next week, but I think you're going to see the selling pick up next week be interesting to see. I'm not sure. I mean, that's what I think is going to happen, but it's always interesting to see kind of what actually happens based on what you think is going to happen. So, all right, everybody. Well, Christmas is fast approaching. New Year 2019 is fast approaching. Make some commitments. Taking control of your own money. I think you'll be happier doing it. You'll feel, if you can educate yourself and follow some rules, I think you'll just be happier and sleep better at night, and not worry so much if you kind of understand the way these markets move and what to look for so that you don't get stuck in the psychology of it all. All right. Now share these videos with your friends and family. It's going to be very, very important. You're going to start hearing. The interesting thing is this year it doesn't look like we're going to have that Santa Claus rally like we normally have. And you're going to be at Christmas with your family, and they're going to be talking about how bad the market is and how much money have you lost and how much money have I lost. And I promise you're going to feel real bad when you say, I haven't lost any, because I watched this guy, Seth Martin. Oh, really? How much does that cost? Oh, it's free. It's free and you didn't send it to me? You're going to feel bad. So don't do that. Don't be that guy or gal. Go ahead and send that stuff to your friends and family now, so that they don't have to experience those losses, okay? All right, everybody, take care, and we'll talk to you next week. Bye-bye.